Imagine the familiar, the quiet murmur of a bank lobby, the rhythmic beeping of a cash counter. Now picture this. You approach the teller, withdrawal slip in hand, ready to access your own money, but instead of the satisfying rustle of bills, you're met with an unexpected phrase. We're running low on cash. Reports of major banks facing cash shortages are surfacing worldwide, sending ripples of concern through the global economy. How could this be happening? Are our life savings at risk? This isn't just a story about numbers and balance sheets, it's about the trust we place in financial institutions. The implications of banks running low on cash extend far beyond the inconvenience of a delayed withdrawal. It signals a potential crack in the foundation of our financial system, a system built on the promise of readily available funds. When banks struggle to meet cash demands, it erodes public confidence, triggering a domino effect. Increased withdrawals, a credit crunch, and a slowdown in economic activity can follow. And from the rise of digital currencies to lingering economic uncertainties, we'll unravel the web of events that have brought us to this critical juncture. Before we dive into the complexities of bank runs and financial meltdowns, let's clarify a crucial distinction: the difference between reserves and liquidity. Reserves are the funds a bank holds in reserve, both in physical cash and deposits at the central bank. Liquidity, on the other hand, is a broader concept that encompasses a bank's ability to quickly convert its assets into cash without incurring significant losses. A bank can have ample reserves but still face a liquidity crisis if its other assets are difficult to sell quickly or if their value has plummeted. Understanding this distinction is key to grasping the current situation. To grasp the gravity of the current situation, it's essential to understand fractional reserve banking. Banks don't keep all the money you deposit in their vaults. They hold only a fraction as reserves, while the rest is lent out or invested. This system works smoothly as long as a small percentage of depositors choose to withdraw their funds simultaneously. However, when confidence in the banking system wavers, this delicate balance can quickly unravel. Even a well-managed bank can find itself short of cash during a bank run. When the music stops, the perils of a liquidity crunch. A liquidity crunch occurs when a bank, or even the entire financial system, faces a severe shortage of readily available cash. Imagine a bank with $100 million in deposits, but it has lent out $90 million and holds only $10 million in reserves. If depositors suddenly demand $20 million in withdrawals, the bank faces a dilemma. This is precisely the scenario that can lead to bank failures, credit freezes, and economic downturns. The erosion of trust, economic uncertainty, and the flight to safety. Inflation has soared, eroding the purchasing power of consumers and businesses alike. This climate of economic anxiety has shaken consumer confidence, prompting many to seek refuge in the perceived safety of physical cash. Holding cash provides a sense of control and security in uncertain times. The irony is that this trend of hoarding cash, driven by a desire for security, could ultimately contribute to the very instability people fear. The digital paradox: how cashless transactions fueled a cash crunch. We embraced contactless payments, online banking, and mobile wallets, marveling at the convenience and speed. Banks, eager to streamline operations, scaled back their cash handling infrastructure. Yet, the recent surge in cash withdrawals highlights the limitations of a purely digital financial system. The very technology designed to render cash obsolete has, in a way, fueled its resurgence. The invisible hand tightens, central bank policies, and the liquidity squeeze. Central banks, grappling with the surge in inflation, have reversed course from the era of easy money. They've embarked on a path of monetary tightening, raising interest rates and scaling back asset purchase programs. While these measures are intended to restore economic balance, they can also have unintended consequences, particularly in terms of liquidity. This slowdown in borrowing activity can reduce the flow of money through the financial system, making it more challenging for banks to access the liquidity they need. Contagion of fear. Bank failures and the domino effect of panic. The financial system operates on a foundation of trust. Recent headlines of bank failures have cast a long shadow over the industry, fueling anxieties. News of even a single bank failure can trigger a contagion effect, spreading fear and uncertainty. The current situation underscores the fragility of trust in the financial system. The allure and anxiety of a cashless future. For years, we've been told that a cashless society is inevitable, a natural progression towards a more efficient, secure, and technologically advanced financial system. However, this utopian vision of a cashless future is not without its skeptics. Concerns about privacy, security, and control loom large. The recent surge in cash withdrawals suggests that many people are not yet ready to abandon physical currency entirely. At the heart of the push toward a cashless society lies the rise of digital currencies, particularly central bank digital currencies, or CBDCs. Proponents of CBDCs argue that they offer numerous advantages over both physical cash and existing digital payment systems. However, the prospect of CBDCs has also raised concerns about their potential impact on individual liberties and financial privacy. Critics point out that CBDCs would give central banks direct access to citizens' financial transactions. While proponents argue that such scenarios are far-fetched, the potential for abuse is undeniable. The current situation highlights a fundamental tension at the heart of our evolving relationship with money: the trade-off between convenience and control. Digital technologies offer undeniable benefits in terms of speed, efficiency, and accessibility. Yet they also come with inherent risks to privacy, autonomy, and the balance of power. As we navigate this complex landscape, it's crucial to find a balance that harnesses the benefits of innovation while safeguarding the fundamental values of a free and open society. The decisions we make today will shape the financial landscape for generations to come. Following the 2008 financial crisis, the global economy floated on low interest rates. Central banks kept borrowing costs at historic lows to stimulate growth. This era of cheap money influenced mortgage rates and corporate investments. Home ownership became more accessible, businesses expanded with cheaper loans, and consumers enjoyed affordable credit. However, low rates posed challenges for banks. Their profit margins were squeezed, reducing the incentive to attract deposits. This led to a decline in maintaining large cash reserves. Digital transactions became increasingly prevalent. The Great Cash Exodus. The economic landscape has shifted dramatically. Inflation has roared back, eroding purchasing power. Interest rates are rising, making borrowing more expensive. This shift has exposed system vulnerabilities. Individuals and businesses are re-evaluating their financial positions, paying down debt and reducing spending, seeking higher returns on savings, triggering a great cash exodus from traditional bank accounts, withdrawing money to pay down high-interest debt, investing in tangible assets like real estate, or keeping it in physical form as a hedge against inflation. For banks, this exodus poses a significant challenge. Reduced deposits limit their lending capacity, grappling with a surge in cash withdrawal demands. The era of easy money has come to an abrupt end. The very thought of banks running low on cash is enough to send shivers down any saver's spine. It conjures images of bank runs, financial chaos, and the agonizing possibility of losing one's life savings. To quell these fears, governments around the world have established deposit insurance schemes, acting as a financial safety net for depositors. In the United States, the Federal Deposit Insurance Corporation, or FDIC, insures deposits up to $250,000 per depositor per insured bank. This means that even if a bank fails, the FDIC steps in to protect depositors' funds up to the insured limit. Similar deposit insurance programs exist in many other countries, offering a degree of protection against bank failures. This safety net, however, is not without its limitations. The insured amount, while substantial for many individuals, may not cover those with larger balances or businesses with significant cash reserves. Moreover, deposit insurance only covers losses resulting from bank failures, not losses due to market fluctuations, fraud, or other factors. The existence of deposit insurance is undoubtedly reassuring, offering a crucial layer of protection in uncertain times. However, it's essential to understand the scope and limitations of these schemes to make informed decisions about where and how to safeguard your hard-earned savings. While deposit insurance provides a vital safety net, the true security of your savings extends beyond government guarantees. The financial health and stability of a bank are paramount. A strong balance sheet and prudent lending practices help banks weather economic storms. Conversely, risky investments and poor management make banks vulnerable. Systemic crises can overwhelm even robust deposit insurance schemes. Government policies, regulatory oversight, and geopolitical events also impact savings safety. We stand at a crossroads in the evolution of money. The familiar comfort of physical cash is being challenged by the relentless advance of digital technologies, while anxieties about economic instability and the erosion of trust in traditional financial institutions fuel a resurgence in the desire for tangible assets. The notion of banks running low on cash, once unthinkable, has become a stark reminder of the delicate balance underpinning our financial system. It has exposed the limitations of a system overly reliant on digital transactions and highlighted the enduring human need for security and control, particularly in times of uncertainty. The future of cash remains uncertain. Will physical currency gradually fade into obsolescence, replaced by the seamless efficiency of a digital-first world? Or will the desire for tangibility and control, coupled with concerns about privacy and centralized power, fuel a resurgence in cash holdings? The answer most likely lies somewhere in between. A hybrid future where physical cash coexists alongside digital currencies and innovative payment systems seems increasingly plausible. The challenge lies in striking a balance that harnesses the benefits of technological advancement while preserving individual liberties and safeguarding the stability of the financial system. In this era of rapid transformation, it's crucial to be proactive about financial well-being. Here are some practical steps to consider. Stay informed. Keep abreast of economic trends and financial technology developments. Diversify your holdings. Don't put all your eggs in one basket. Diversify savings across different asset classes. Reassess your banking relationship. Evaluate your bank's financial health and digital security. Embrace technology wisely. Use digital tools judiciously and prioritize security. Advocate for a balanced approach, support policies promoting innovation and protecting individual liberties. Navigate the evolving financial landscape with confidence and resilience.